Gold is fighting for $4,000 an ounce, and the entire financial world is staring at that number like it means something. Traders are drawing lines on charts, analysts are arguing about whether the floor holds. Everyone has an opinion about 4,000, and almost all of them are looking at the wrong thing. Because that level is not the story. That level is the distraction. The reason gold is grinding sideways at $4,000, unable to break down and unable to break out, is that the market is trying to price something it has never had to price before, something it has no formula for. And when a market cannot price something, it does exactly what gold is doing right now. It stalls, it fights, it looks confused. Let me show you what it's actually trying to price, because once you see it, you will never look at a rate decision the same way again. Start with what everybody agrees on. Gold sits around $4,000 an ounce, roughly 20% below a peak that got close to $5,000. Silver has been cut in half, from over $121 down to about $57. Inflation is running at 4.2%, a 3-year high. Oil is up 11% on the crisis around the Strait of Hormuz, the waterway that about a fifth of the world's oil has to squeeze through. And the Federal Reserve, under Chairman Kevin Warsh, is hawkish, genuinely, seriously hawkish. The market now prices roughly a 65% chance of a rate hike, not a cut, a hike. The odds of a cut have collapsed to about 2%. The minutes of the most recent meeting showed the committee split 9-8 on raising rates. 9-8. One vote. So the conventional story writes itself. Hawkish Fed, higher real yields, gold pays no interest, gold gets sold. Clean, tidy, and true as far as it goes. But here's what that story leaves out, and it's the biggest thing in the room. It assumes the Fed can actually do it. Real quick before I go further, because this next part is the whole video. If any of this is making you think about your own retirement accounts, I put together a free retirement protection guide that walks through exactly how retirees are shielding their savings in this kind of environment. It's completely free. The link is in the description, or you can just scan the QR code on your screen right now. It takes 2 seconds. Okay, back to what's really happening. There is a phrase economists use for what I'm about to describe, and it's a dry, bloodless little phrase for something that decides whether your retirement holds its value. The phrase is fiscal dominance. Here's what it means in plain English. Normally, a central bank sets interest rates based on the economy. Inflation too hot? Raise rates. Economy too cold? Cut rates. The government's budget is somebody else's problem, over in Congress, in a different building, on a different set of books. The Fed does its job. The Treasury does its job. They don't sit in each other's laps. Fiscal dominance is when that stops being true. It's when the government owes so much money that the interest bill on the debt becomes the loudest voice in the room. At that point, the central bank is no longer setting rates purely to control inflation. It's setting rates while somebody in the corner keeps clearing their throat and pointing at the invoice. Monetary policy stops being independent. It becomes a hostage of the budget. And that is not a theory. Look at the arithmetic. The national debt is north of $38 trillion. The interest the federal government pays on that debt has already blown past $1 trillion a year. Just interest. Not roads, not defense, not Social Security, not a single thing you can point to. Rent on money already spent. That number is the fastest growing line in the entire federal budget, and current projections have it climbing toward $1.3 trillion within a few years. Now, here's the part that matters for gold, and almost nobody says it out loud. When the Fed raises rates, that hike does not just land on mortgages and car loans, it lands on the Treasury. Every time the government rolls over a maturing bond, it refinances at the new, higher rate. The debt does not sit still at the old rate like a fixed mortgage on a house you never sell. It rolls, constantly, trillions at a time. Which means every quarter point of tightening is also a compounding, permanent increase in the government's own cost of existing. Sit with that, because it inverts everything you were taught. In a normal economy, a rate hike is a brake. It slows things down. But when the government owes $38 trillion, a rate hike is also a spending increase. The Treasury has to pay more interest, and that interest goes out the door to bondholders as cash into the economy. You are stepping on the brake and the gas at the same time, with the same foot. So Kevin Warsh, a man who genuinely wants to break inflation, who has spent his whole career arguing that money has been too easy for too long, is walking up to the plate with one hand tied behind his back. And it isn't tied there by politics. It's tied there by arithmetic. He can be as tough as he wants, right up until the moment the interest bill eats the budget. And then reality has a vote too, and reality votes last. That is what gold is trying to price at $4,000. Not the hike, the credibility of the hike. Think about how strange that is. A market is not arguing about what the Fed will do, it's arguing about what the Fed can do. And that is a question with no historical precedent in modern America. No model, no formula, no clean answer. So the price does the only thing it can. It sits there and fights. And it gets worse, because look at what this inflation is actually made of. 4.2%, a 3-year high. What's driving it? Tariffs, a war premium on oil after the strikes on Iran, with the Strait of Hormuz in play, and an enormous, historic wave of capital spending on artificial intelligence infrastructure. Now ask yourself an honest question. Which one of those does a rate hike fix? Raising the cost of borrowing in Ohio does not reopen a shipping lane in the Persian Gulf. It does not repeal a tariff. It does not stop a company from building a data center it has already committed billions to. These are supply-side shocks and policy decisions. Interest rates are a demand-side tool. Warsh is holding a wrench and staring at a leak in a different building. So he's fighting an inflation his tool doesn't fit with a tool that also raises the government's bills every time he uses it. That's the box. And gold at $4,000 is the market standing outside that box, squinting, trying to figure out how anyone gets out of it. Now, here is where somebody always says, Blake, this is speculation. Fiscal dominance is an academic scare story. Central banks are independent. It says so. No, America already lived this. Not in some far-off country with a funny currency. Here. And it took an open institutional revolt to end it. Go back to the middle of the last century. During the war, the Treasury asked the Federal Reserve to do something remarkable, and the Fed agreed. It committed to pinning interest rates on government debt. Short-term Treasury bills got held at 0.3%. Long bonds were effectively capped around 2.5%. Not because that's what the economy needed, because that's what made the war affordable to finance. And understand what that actually meant. The Fed was no longer a central bank in any meaningful sense. It was the Treasury's financing department wearing a central bank's uniform. Whenever the market tried to push yields up, the Fed had to step in and buy bonds to force them back down. It could not say no. Its independence existed on paper and nowhere else. Then the war ended, and the bill came due in the way bills always come due: inflation. In one 12-month stretch, consumer prices rose more than 17%, then another year near 10%, and still the peg stayed, because the Treasury liked cheap money and had no intention of giving it up. Then came Korea. New war, new spending, new debt to finance. And by early in that year, inflation hit an annualized rate of about 21%. 21%. The Fed was staring at the prospect of having to monetize an enormous new pile of government borrowing, which would have poured gasoline on a fire that was already out of control. The committee knew it, and they finally, quietly refused. What happened next is one of the strangest episodes in American financial history, and almost nobody knows it. The president invited the entire committee to the White House. After the meeting, the White House put out a statement announcing that the committee had pledged to keep supporting the government bond market for as long as the emergency lasted. Except they hadn't. No such pledge was made. The statement was simply not true. And so a former chairman, Mariner Eccles, did something a central banker almost never does. He went to the press. He handed the newspapers a memorandum laying out the committee's actual position, that no commitment had been given, in public, against the President of the United States. And then the committee went further and wrote to the president directly, telling him that the inflation eating the country was caused by exactly this arrangement, by a central bank being forced to monetize the government's deficits. That's not a policy disagreement. That's a revolt. Within weeks, the Fed told the Treasury flat out that it would no longer hold the peg. The bond market was already coming apart. The Treasury had to negotiate, and the two sides issued a joint statement, an accord, in which the Fed finally got its independence back. There was a price. The sitting chairman resigned. His replacement was the Treasury's own man, sent over to keep an eye on things. That accord is the birth certificate of the modern Federal Reserve. Everything you assume about central bank independence, everything dates from that fight. It is not the natural state of affairs. It is a hard-won exception that had to be seized in a public brawl. and it took a 21% inflation rate to make it possible. And here is the detail that should stop you cold. Through that entire decade of fiscal dominance, through the peg, through the 17% inflation, through all of it, gold was fixed. Fixed by law at $35 an ounce. It could not move. It could not warn anybody. The one instrument that exists to tell you what your money is really worth had been gagged. So the savers of that era had no signal. They watched their bonds pay 2.5% while their groceries went up 17%. They found out afterward. You have the signal. It's the number everybody is arguing about. And that brings me to something that matters, especially if you're sitting on $100,000 or more in a retirement account, a 401k, an IRA, anything like that. Because this is exactly the kind of environment where the decisions you make actually count. I put together a free retirement protection guide that covers the strategies retirees are using right now, including how some are moving a portion of their retirement savings into physical gold without triggering taxes or penalties inside the tax-advantaged account they already have. It walks through it step by step, in plain English, and covers the mistakes that cost people real money. It's in the description, or scan the QR code on your screen. And if you go through the guide and want to go deeper, there's a free, no-obligation, one-on-one educational session available for folks with $100,000 or more in any retirement account. Just answers. No pressure, nothing to buy. Okay, now let me show you why today is harder than the fight they won. Because there's an ugly comparison sitting here, and it runs the wrong way. When that committee revolted, they were revolting against a peg, a policy, a choice somebody had made that somebody else could unmake with a signature. Painful, yes, but it was a decision, and decisions can be reversed. What Warsh faces isn't a decision, it's a balance sheet. Nobody can sign a memo that makes $38 trillion go away. There is no accord to negotiate, no press leak that fixes it, no chairman who can resign it into submission. The old Fed could wean its independence back because the only thing standing in the way was a policy. Today, the thing standing in the way is the debt itself, and the debt does not negotiate. That is the bigger problem. That's the thing the $4,000 battle is actually about. And now put the pieces together, because they lock. Warsh is hawkish. Everyone believes he means it, and I believe he means it. So the market prices 65% odds of a hike and 2% odds of a cut, and gold, which pays no interest, gets sold into that. 20% off the peak. Silver cut in half. That part is rational. But every one of those hikes lands on the Treasury as a bigger compounding interest bill. And the inflation he's hiking into isn't the kind hikes fix. So the tightening either stops working or it stops being affordable. And the market cannot tell you which, and neither can I. That's why the price is stuck. $4,000 is not a floor or a ceiling. It's a question mark with a dollar sign in front of it. And notice who is not confused. Right into this decline, UBS raised its 12-month target on gold to $5,200 an ounce, roughly 30% above where it sits now. They called this weakness a buying opportunity. Their reasoning is worth hearing because it maps exactly onto everything I've told you. 1. The market has the Fed mispriced. 2. Dollar positioning is stretched given America's fiscal and external deficits. 3. Steady central bank buying puts a floor under the price. They expect the Fed to hold through this year and not cut until the year after. And a cluster of major institutions, State Street, Goldman Sachs, the World Gold Council, UBS, MKS PAMP, all published constructive gold analysis within the same week into the teeth of the selling. And watch the central banks themselves. They have been accumulating physical gold at a generational pace. Not paper claims, metal, in their own vaults on their own soil. Ask yourself why institutions that can create currency out of thin air would hoard the one asset they cannot print. They are not making a call on gold's price. They are hedging against the arithmetic I just walked you through. And they are the only people on Earth who see that arithmetic from the inside. Meanwhile, ordinary buyers are doing the opposite, as always. Not long ago, Chinese buyers were paying premiums of 12 to 13% over the world price just to get their hands on actual metal, importing around 790 tons of silver in the space of 2 months. Today, that market has flipped to a discount and gone quiet. One Shanghai shop watched daily sales collapse about 90%, from a couple of kilos a day to a couple hundred grams. The reason given wasn't a change of mind. It's that they expect the price to fall further and they're waiting for a clearer picture. They paid a premium when it was exciting. They won't pay the asking price now that it's frightening. That is the exact opposite of how you behave buying anything else in your life. Now, let me be honest about the risk, because I'm not interested in selling you a fantasy. Warsh could win. He could hike, the economy could take it, inflation could genuinely break, real yields could go higher, and gold could get cheaper from here than it is today. That is a real possibility, and anyone who tells you otherwise is selling something. Fiscal dominance is a pressure, not a prophecy. Pressures can be resisted for a long time, sometimes longer than a person's retirement lasts. Nobody can give you a price, and nobody can give you a date, and the second someone does, close the tab. And there's a harder version of the honesty. Even people who were right about all of this have been destroyed by the timing. In the great inflation of the 70s, gold went from $35 to over $800. And in the middle of that run, during the inflation, while the thesis was working, it suffered a drawdown of roughly 40%. The people who were right got shaken out anyway. Being correct and being early can feel identical right up until the end, and only one of them pays. But here's the arithmetic that makes me take the fiscal dominance case seriously anyway. Every chairman in history who broke an inflation did it in a country whose debt was a fraction of today's. Rates in the high teens were survivable then. Ask honestly whether this country could survive 8%, with 38 trillion outstanding and an interest bill already north of $1 trillion. The interest expense alone would swallow the budget whole. And that is the whole of fiscal dominance in one sentence. It does not require anyone to lose their nerve. It does not require a bad chairman or a political deal or a phone call from the White House. It only requires the invoice to get big enough that the arithmetic makes the decision before the committee ever votes. The tightening does not get abandoned. It gets outpriced. So here's where I'll leave you. The battle at $4,000 is not about $4,000. It's the market trying to price a central bank that may not be able to do what it says, in a country that already lived through exactly this once and needed a public revolt to escape it. And the last time it happened, gold was fixed by law at $35 an ounce, so it couldn't tell anybody. This time, nobody gagged it. This time, the argument is happening in the open, in the price, right in front of you. If today raised more questions than it answered about your own savings, that free retirement protection guide is still in the description, and the QR code is on your screen one more time. It costs you nothing to be informed. And for those of you who stuck with me all the way to the end, here's something just for you. If you have $100,000 or more in any retirement account, and you mention that you watched this full video, you can claim a free, one-on-one, no-obligation educational web conference. A real conversation about your specific situation with no pressure and nothing to buy. That's only for folks at that level who made it all the way here. And you're one of them. Scan the QR code, grab the guide, and take the first step toward protecting what you spent a lifetime building. Because the people who lived through the last one didn't get a warning. You're looking at yours.